Okay, good afternoon and happy new year, everyone. Welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are kicking off 2021 with a options topic that I haven't covered in a while, but I get a lot of questions regarding this because we do trade quite a bit of these, both debit and credit spreads. Recently, we've been selling a lot of credit spreads this year, predominantly because volatilities have been very elevated. This has produced the type of environment that has been successful with selling option strategies, but we have taken a few debit spreads as well, whether you traded recent ones like Plug Power earlier this week or Electronic Arts from a couple of weeks ago. These are all different types of spreads that we're currently trading in our daily plays. And we get a lot of questions from investors asking us the difference between the two, and they're actually quite different from each other. They're as different as buying options as selling options, and we usually think of buying options and selling options as very different from each other. And reality, when you look at debit and credit spreads, they are just as different. So today, that's what we're going to break down and hopefully help you guys better understand these strategies. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So just to give you a sense for the January calendar here, what we have is today we're going to be talking about debit and credit spreads for today. But on next Tuesday, actually, we're going to have a special session again with Tom Sosnoff and Tastyworks. Many of you love the sessions that I've been doing with Tom Sosnoff, so I'm glad to be able to have him back and show you guys another market outlook session. What we're going to do is we're basically going to look at the markets together, look at different trading ideas, and use the Tastyworks platform to look at different ideas and talk to Tom about different strategies and answering your options education questions. The following Thursday, what we're going to do is we're going to talk about calendar and diagonal spreads. And that really is, from my perspective, the next step in understanding debit spreads, because debit spreads and diagonal spreads and calendar spreads are actually very similar in nature. They're different strategies, but they're based on the same fundamental principles. So we're going to take a look at debit and credit spreads today. We're going to take a look at slightly more advanced strategy, calendar and diagonal spreads the week after. And then this is actually the 21st here, we're going to talk about trading earnings. Trading earnings using options. And I'm going to give you a little deeper dive into how we look at options around earnings. How do I research the ideas around earnings? A lot of questions from investors asking us, what metrics do we look at to determine whether a stock might beat or miss on earnings? So we're going to dive into some of that as well, give you a little glimpse into the type of research that I do when we put out trade ideas that are on earnings, such as the ones that we do on CNBC. So Bill, you're right. I messed up some of the dates on there. We'll correct that before we send that out. So today's session, we're going to start off. We're going to talk a little bit about the difference between stock versus option strategies. We're going to talk about bullish strategies. We're going to talk about bear strategies. But the examples today I'm going to give you are only going to be focused on bullish strategies. You can take the same concepts and apply them to bearish strategies. They're effectively just a mirror image of each other. But today, just for the sake of time, so that I can actually dive into each one of these a little deeper, we're going to start off our conversation talking about buying call options. That is a simple strategy that most of you understand. We're going to show you how you can improve the challenges of buying a call option using a debit spread. And then what we're going to do is we're going to flip this on a dime, and we're going to show you selling a put option, which is quite different from buying a call option, and show you how you can improve that by selling a credit spread. And once we go through these four examples, we'll be able to directly compare debit spreads and credit spreads to each other. And then what we'll talk a little bit about is how do you select the optimal debit and credit spread? And more importantly, how to manage them. So once you're in a debit spread, once you're in a credit spread, how do you manage them? And then at the end, we'll open this up for Q&A and try to go through a few examples. So the primary question that I want to help investors answer here off of the session here today is predominantly around how are debit and credit vertical spreads different from each other? And the reality, again, is that they are very different from each other. And it's important that we understand how to analyze them. And just a quick reminder, tomorrow morning, another members only session. We're going to be doing electric vehicles. A lot of questions from investors over the past few weeks regarding NIO, around the Tesla, regarding all of the other electric vehicle companies. So we're going to do a deep dive into this whole industry, a deep dive into specific companies within the electric vehicle space. So I hope to look forward to seeing you guys tomorrow morning. If you're a member, you're automatically registered for it. You don't have to do anything. You'll automatically get the email an hour before we start tomorrow. This is at 8:30 a.m. tomorrow morning. So you'll get an email at around 7:30 in the morning with your link to log in, just like the one that you did here for today. So you don't have to do anything. If you're a member, you're automatically registered for that event. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what I want to do is I want to really take that deep dive into the fundamentals between buying versus selling options so that you can better understand the difference between debit versus credit spreads. So we'll start off the conversation talking a little bit about the difference between stock versus options trading. And we're going to break this down into bullish and bearish segments here, but today what we're going to do in terms of examples is we're only going to go over bullish examples. We just don't have enough time to go through the mirror image of it from the bearish side, but once you understand the concepts of the bullish side, the bearish side will be just as easy to understand. There won't be any additional education that you need to understand the bearish side. So when we talk about bullish exposure, you really have three choices. You can buy the stock, you can buy a call, a call debit spread. This is the first bullish strategy we're going to go over as the vertical spread, and then the second bullish vertical spread we're going to go over is selling a put vertical credit spread. Now, selling put vertical credit spreads, for any of you that have been members or following OptionsPlay for a while, you're probably quite familiar with them because we've traded a lot of them through our daily plays, especially recently. When volatility is high and elevated as they are right now, it favors selling these types of credit spreads. When volatility is relatively low, or when we believe the stock is going to make a big move to the upside, that's when it makes more sense to buy that debit spread. So for example, Plug Power, the trade that we put in on Monday morning, that was a debit spread because we felt that Plug Power had the potential to make a big move. And that's exactly what we saw here today. And I'm glad we used the debit spread and not a credit spread, because if you sold the credit spread, you wouldn't have been able to participate on that. So those are some of the things we're going to go over here today. Now, on the bearish side of things, what you're going to see is that you can short the stock. That is the simplest, or that's the only stock strategy that you can trade if you're bearish on a stock. And then what we're going to do is we're going to look at buying a put debit spread or selling a call credit vertical spread. So like I said today, we're not going to cover those two strategies, but again, those are just mirror images of what we're going to take a deeper dive into here today. So for the first example, what we're going to do is we're going to look at a bullish strategy. Now, before we dive into debit and credit spreads, we're actually first going to look at single legs, because once you understand the single leg, you're going to understand the debit spread. So for those of you that are new to options or new to trading multi-leg options, don't worry. What we're going to do is we're going to take it one step at a time, start with single leg, make sure you understand that, then progress to the multi-legs. And what you'll see is that the multi-legs, really, they're not too complicated. They're just a slight improvement of the single leg strategies, okay? So before we get started, could everyone please bring up your chat window, which is at the bottom of your screen? And please type 1 into the chat window if you're just in the learning process of how to trade options. And please type 2 into the chat window if, let's say, you have experience trading options. Okay, so I see a lot of 2s, but I'm seeing plenty of 1s being put in there in between the 2s. So most of you have experience trading options, but again, for all of you that have responded with 1, this is going to take it one step at a time, starting from the beginning. And then if you're an experienced options trader, I really think that you will learn something regarding these types of strategies that will improve your ability to use these strategies. So first off, we're going to use stock XYZ trading at $100. And I believe that this stock is going to go higher. Maybe I think the stock is going to rally to 110, right? So I think the stock's going to go higher. So what can I do? As a stock investor, I would buy the stock. As an options an investor, the first strategy that I would look at is buying a call option. So let's say I buy a call option. I buy a $100 call option, the at the money strike price, and I pay $4 for that call option. Now, when you learn about these types of strategies, you learn very quickly that when you buy a call option, you get unlimited upside. So as the stock keeps going higher and higher and higher, you make more and more money. But the flip side, if you're wrong on your strategy, the most you can lose is the $4 that you pay for the call option. And this is what we call an asymmetrical risk, meaning unlike stock trading that has symmetrical risk, for every dollar the stock goes up, you make a dollar. For every dollar the stock goes down, you lose a dollar. When you're trading options, it's not symmetrical, it's asymmetrical. And it works in your favor when you buy an option like a call option, where if you get the direction right, you can make more and more money as it keeps going in your favor. But if it goes against you, the most you can lose is $4 a share in this particular case. And that's really what attracts a lot of investors to looking at these types of strategies, being able to leverage your capital, right? Controlling a $100 stock for just $4, and then doing so where if you're right, you get leverage your capital, and if you're wrong, you only risk $4 a share. Doesn't that sound fantastic? Why wouldn't we all just buy call options when we're bullish on a stock and never buy the stock ever again? Because when we buy the stock, you're risking $100 a share. And the answer is that it's not that simple, because when you buy a stock, the second the stock goes higher, you start making money. But when you buy a call option, it's bullish by a certain amount. And what I mean by this is that your break-even point of an option is actually the strike price plus the premium that you pay. So whenever you buy a call option, not only do you have to believe the stock's going to go higher, it has to overcome the break-even price just for you to be profitable. So in this case, if I think the stock's going to go from 100 to 110, then in this particular case, because it exceeds my 104 break-even point, I am profitable here. So I'm effectively making $6 if the stock rallies up to 110, while I'm risking, in this particular case, $4 if the stock declines below 100. So my potential reward here is about, in this particular case, risking 4 to make 6 is 150% return on my capital if I am correct on this trade. Now, this is just a 10% move in the underlying stock. I'm going to make 150% return on my capital. But the challenge here, the challenge with the call option is, yes, you get unlimited upside for limited losses, but if let's say you get the directional move wrong, if you get the directional view correct, but the stock doesn't move as far, you can actually get the direction right and still lose money on the trade. That's something you can't do when you buy a stock, but when you buy an option, if you buy a call option, the stock can go in your favor, but if it doesn't go far enough, you can actually lose money on this trade. And if anyone can relate to that, please type 3 into the chat window if you can relate to that. When you bought a call option, the stock went higher and you still lost money on that trade. That's the biggest challenge with buying a call option. Now, if the stock stays where it stays put, you lose $4. If it goes down, you lose $4. So the reason that a lot of investors, after a while don't particularly love buying call options is because if the stock goes lower, you lose money. If the stock stays the same, you lose money. If the stock goes a little bit higher, you lose money. The only time you make money is if the stock makes a big move here to the upside. And if it doesn't make that big move, you're likely either going to lose the amount of capital that you put in, 100% of the capital that you put into that trade, or a percentage of the capital that you put in. And that's the biggest challenge with buying a call option. Richard says it's like buying a lottery ticket. Not quite, but certainly low probability payoff type trades. High risk to reward, meaning if you are right, you get paid a substantial amount of capital or a substantial return, but there's a higher probability that you'll actually lose money on this trade. So to understand debit spreads, what we want to do is just understand that debit spreads, what they're doing is they're improving your odds a little bit on this particular trade. Now, before I move into debit spreads, does the call option make sense to everyone? Please type 4 into the chat window if the call option makes sense and the challenges with call options make sense to you. Okay. So now let's take a look at debit spreads. Debit spreads are identical to what I just showed you here before, but we're going to make one small adjustment. So stock XYZ, again, $100 stock. I think the stock is going to go to 110. I think it's going to go higher. So what I'm going to do is I'm going to look at buying a debit spread. Now, what is a debit spread made of? Now, even if you have no idea what a debit spread is, we're going to walk you through this. So I'm still going to buy the same $100 call option. It's still going to cost me $4. And if I just buy the call option, I have the same challenges that I had before. But the one thing that you'll remember is that when you buy a call option, what you're buying is unlimited upside. You're basically saying that in theory, I believe the stock could go to $200 or $300 or $400. And remember, there's an expiration date. It has to make that move before that time. So whenever you have an expiration date, you can also make some calculations as to, okay, between now and let's say 2 months from today, maybe I don't think the stock, maybe I think there's no chance the stock's going to be at 130, 140, 150. So why should I pay for all that upside? And this is really the beauty of options, because you have, number one, a lot of options, and you can get really creative with what you can do with all of those options. And the debit spread, in my opinion, is just the first example. If you're brand new to options trading, the first example as to how you can take some of this creativity and use it in your favor, okay? So when I buy a call option, I'm buying unlimited upside. But why should I pay for that if I don't think it's going to happen anyway? And this is really where, when you're trading options, you can do something about it. You can say, okay, I'm going to buy the $100 call option, which gives me unlimited upside, but I'm going to sell off some of that upside because I just don't think the stock's going to go to 120 or 130 between now and 2 months from today. So let me sell off some of that premium. Let me sell off some of that upside, and in exchange, have someone else pay me a premium. When you buy a call option, you have to pay, but when you sell an option, you get paid. Now, when you sell options, there are other complexities here, but when you're buying an option, you're effectively hedging that risk that you're just selling on the short option. And that's really the beauty of options, is when you can offset your risk and offset your risk, that's really where you can pay some dividends here. So in this particular case, what I'm going to do is I'm going to sell the 110 call option, basically saying, I don't think it's going to go above 110. So why should I pay for that? Collect $1 for it. Now, what I'm doing is I'm effectively buying a very similar upside as I was doing before on the call option. I get very similar upside, but my risk is now just reduced from $4 a share to $3 a share. Now, this doesn't change the thing from day to night, but it does shift the pictures quite a bit. Before, the stock had to go above 104 before it's profitable. Now it only has to go above 103 and it's profitable. So I have a higher probability of profit. And what I've done is I've just exchanged my upside above 110 in exchange for this $1, something that I don't think is going to happen anyway. So now what I've done is I've reduced my max risk to $3. I've capped my max reward to $7. And what this means is that if I do get the move from 100 to 110 that I had anticipated, what I'm making here in this particular case is $7 versus the $3 that I'm risking. Now, a $7 profit off of a $3 trade or $3 risk is a 233% return. So basically, if the stock makes a 10% move that I'm expecting it to make over the next 2 months, and I traded a debit spread, I would be looking at a 233% return versus the 150% return before if I had just bought the call option. Before, I showed you with the call option, I'm making 150% return on that option. Here, I'm making 233%. So I've reduced my risk because I've reduced from $4 to $3. I've increased my potential reward because I've reduced my risk. And number three, because my break-even price is now at 103, I have a higher probability of success because the stock doesn't have to move as far before the strategy is profitable. So that is where you can take a look at these types of strategies and understand why someone wants to trade a debit spread. It's really just taking a call option and improving the risk to reward ratio a little bit, improving your potential return, and improving your potential for profit. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Okay, so that's the key of a debit spread. Now let's flip this on a dime. Let's talk a little bit about selling options before we jump into the credit spread. So so right now, again, stock XYZ trading at $100. I think the stock is going to go higher. Now, when you sell a put option, it's a little different than buying a call option, but your risk profile is very different, but your views on the stock are fairly similar. So when you sell a put option, even though technically it falls under the bullish category, I think the more accurate description of what selling a put option is when you're somewhat bullish, but not too much. Meaning you think it's going to go a little higher, but you don't think it's going to go a whole lot higher. That is when you want to sell a put option. And I think and I'll show you some examples of this in a little bit. But in this particular case, if let's say I'm somewhat bullish, but not too much, what I can do is I can sell a $100 put option. In this particular case, let's say I collect $4 in terms of a credit. Now, what happens when you sell a put option is that as long as the stock stays above the strike price that you sold, you're going to keep the $4. So if it stays where it is or moves higher, you keep the $4. Now, if the stock goes below your strike price, the further it goes lower, the more you lose. And technically, even though technically there is a limit to how much money you can lose because the stock can't go below zero, but I still like to think of that as unlimited downside, because in theory, the stock can go all the way to zero, and the further it goes down, the more you lose. It's not like at some point you stop losing money per se. It's just that when the stock goes to zero, you can't lose any more than zero. So from my perspective, I still call that unlimited downside. So as you can see here, a lot of investors, when they first look at this type of strategy, they say, well, why would anyone want to take on $400 worth of potential reward and in exchange for that, take on unlimited risk? That doesn't make a lot of sense. And the answer is sure, in many cases it doesn't. But the one thing you have to remember is the attractiveness of the strategy is before when we talk about a call option. If the stock stayed the same, the stock went lower, the stock went a little bit higher, you lose money in a lot of different scenarios. Only if the stock makes a big move to the upside do you make any money. Now, when you sell an option, the exact opposite happens. When the stock's trading at $100, I think it's going to go higher, right? If it goes higher, I make money. But if the stock doesn't move at all, if it stays at $100, I make the same amount of money. I still make the $4. If the stock goes against me, even if it goes down to 98, guess what? Even I got the direction wrong, I can still make money on this trade. If the stock goes to 96, I actually still don't lose money on the trade. I've broken even on this trade. I only lose money if the stock makes a big move to the downside. And many investors, when they trade this type of strategy, they're making some calculations. They're basically saying, okay, I don't think the stock's going to zero anyway, but there's a possibility that maybe it goes down to 90, right? So if I get this wrong and the stock goes down to 90, then I'm not risking unlimited amounts of money. What I'm really risking is, in this particular case, let's say $6 in exchange for making $4 if the stock stays higher, stays the same, or moves a little bit lower. Does that make sense, everyone? Please type 6 into the chat window if selling a put option makes sense to you. Okay. So it's not the best strategy per se, because you are ultimately still taking on this unlimited downside, right? And we never know what can happen. The stock can have a bad earnings. The stock can make a big move to the downside on some news. So the reality of what stops many investors from selling put options is this fear of having this unlimited risk. And that's where credit spreads come in. Credit spreads, again, allow us to use the creativity of options to offset some of this. So in this particular case, same example, stock XYZ, $100. I'm bullish on it, but not too much, meaning I think it's going to stay where it is, move a little bit higher. I don't think this is the type of stock that has the explosiveness like Plug Power does. I just think that it could make some slow moves to the upside. Maybe this is like a Walmart or that type of blue chip stock. You don't think it's going to make a big move. So what you do is you sell the $100 put, you collect the $4 credit, but again, because you don't want to take on unlimited risk, what you can do is you can buy a lower put. So again, we're doing the same thing. We're selling this $100 put. In exchange, we're collecting $4. So if the stock goes higher, I make money. But because I don't want that unlimited risk factor, what I'm going to do is I'm going to buy a lower put. When I buy that lower put, what that does is it offsets the risk of the long put. Anything below $90, Whatever I lose on the short put, I'm going to make back on the long put. So that's really how a credit spread works. You're basically have the very similar risk profile as selling a put, but you're cutting your losses to the downside if it makes a big move to the downside. So what I have to do then in order to sell the credit spread is that I do have to pay $1 for this $90 put. What that does is it reduces my total credit on the trade from $4 a share that I had before, now down to $3 a share. So I'm giving up a little bit more of my credit. So in this particular case, if the stock goes higher, I still make money. I just make less money here. In this particular case, I only make $3. If the stock stays exactly where it is, I also still make money, but I just make a little less. I make $3 instead. And now my break-even price before was $96. Now it's $97. So I have a slightly smaller buffer to the downside for the stock to go lower, but still be profitable. But in exchange for that $1 in potential reward that I give up, what I gain in conjunction for that is I no longer have this unlimited risk of the downside. So if you are, in the back of your mind concerned, what if I wake up one morning and this stock's down, at $50, you don't have to worry about it. By buying that $90 put, no matter how far the stock goes below 90, even if it goes to zero, you cannot lose more money on this particular trade. So that is the anatomy of a credit spread. You're really just taking a short put or a short call and improving it slightly by buying that out of the money call or put by reducing your risk. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. Okay, perfect. So in this particular case, before we go any further, I do want to go through a real example because we've gone through XYZ. I think you guys understand the concept, but I think the best way to learn always is using a real example here. I'm going to use Apple here because Apple's made a pretty nice run recently from 113 to 138 or so, pulled back all the way down to 126, roughly a 50% move to the upside, and is now starting to resume its way higher here. So let's take a look at a few different examples of how to trade this particular strategy. And what I'm going to do is I'm going to use this to set up a credit spread. We'll use, let's say, a 130, and I'll show you why I'm using the 130, 120 in a little bit. So what I'm going to do is I'm going to compare selling the credit spread to buying a debit spread. So the best way to take a look at this is, Apple's trading currently at around 130, 131 or so. So let's say I think the stock's going to resume back up to, let's say it's 138 region in this particular case. So from my perspective, Apple's currently at 131. I think it's going to go up to 138. That for me is not overly bullish. That's mildly bullish. So right off the bat, just on that alone, I think I would prefer to trade the credit spread. Now, if you are in the camp that you believe that Apple's going to exceed that level and greatly exceed that level, that's when theoretically you should be looking at buying the debit spread. But let's compare the two side by side, and I think that will help solidify, understanding these types of strategies. So we're going to use our P&L simulator. This is the tool that you have access to here at OptionsPlay. You can type in any strategy, use the strategy constructor. You can construct any strategy that you like. I constructed a short put vertical here, and we're going to use our P&L simulator to compare the two strategies. Now, I always tell investors, before you trade any type of strategy, before you look at potential reward, always look at what the risk is. Look at if you can handle the risk, because a lot of investors, unfortunately, and unfortunately with options, I see too many investors jump into strategies not really truly understanding their risk, hoping to figure it out as they kind of go along, not knowing how much risk they're taking. I never ever advocate for that. Always understand your worst case scenario, how much you can lose on a trade, and ask yourself before you get into that trade, if I was to lose 100% of the max loss on this trade, would I be comfortable in my portfolio, or would I have suffered such a big loss that I would have trouble to continue trading? I've seen too many times where traders trade way too large, not really thinking about their max loss, thinking that that's not going to happen to me, having their account effectively blown up as a result of it. And that is, no one wants that. So please always look at your worst case scenario first. Ask yourself, am I comfortable with it? If it is, then proceed with looking at potential reward. So here, as I said, if let's say I'm just dead wrong on Apple and it returns back to 115, maybe markets get a little jittery, we sell off to 115. Here on the credit spread, I lose $607. On the debit spread, I lose $564. The two are very similar to each other in terms of max risk here. It's only within $50 or so of each other. So the two have very similar risk profiles. Now let's take a look at, well, what happens if Apple just stays put? Let's say it doesn't move at all. I think it's going to go higher, but over the next couple of days, it goes a little higher, goes a little lower, and ends up a couple of weeks later here at 130. Now, if we hold this to, now this is assuming we hold to expiration. We can choose, different dates before expiration, but you can use this and see, how these strategies perform. We're going to use expiration for now just to make it easy to compare. So if the stock stays exactly where it is, as you can see, if I sold the credit spread, here I make 100% of the profit, $393. What the amount of credit that I sold the credit spread for. I'm selling it for $393. My risk is $607. Here, my risk is $564, but my potential reward is $1236. So if the stock stays where it is, I'm far better off selling the credit spread, right? Now, if the stock moves a little bit higher, I said, what if it revisits its all-time high around 138? Now, as you can see here, the credit spread still makes the $393. That's the full credit that I receive. On the debit spread, I only make $136, which is a 24% return. Remember, the two have very similar risk profiles, so I think I can actually compare the profits against each other. One is making me almost $400. The other one's only making me $136. That's why, again, the challenge with buying a call option or a call spread, and if you just bought the call option, notice here, if the stock went from 131 to 138, you would actually lose 10% of the premium that you paid. That is the worst part about trading options, is getting the direction right, but then losing money on the trade because you chose the wrong trade structure. So it's very important to understand these trade structures, even if you're not trading it, just so that you can better understand how to utilize options for your portfolio. So if the stock goes higher to 138, here you're still going to make the full $400. Here you make 136. But what if it goes higher? Let's say it goes to 145. Now, notice how that $6 difference here in the underlying stock makes such a big difference. Remember, when you sell a credit spread, the most you can make is the credit that you receive. And this becomes your limiting factor when you sell a credit spread. And that's why I tell investors, don't just sell options all the time, or don't just buy options all the time. I had a couple of investors ask me questions over the past few days. I heard somewhere that, you should only sell options because that's where you make the most money, or that's where you can make money more consistently. And the answer is true. Yes, you can make more money more consistently selling options, but you're also very limited in terms of the amount of potential that you can make when you sell options. And this is an example of this. If Apple does make a big move here to the upside, here I'm making $836 for the $500 that I'm risking. So I'm making more than about 150% return on my capital. And if it goes even further, the more it goes, as you can see here I'm only making the $400 versus here I'm making over 200% return on the $1,200 on the same $564 of risk. So this is how you can use the tool of OptionsPlay to plug in any symbol that you like, whether it's Apple or Walmart or something more exotic or volatile like NIO, which is one of the stocks we'll cover tomorrow morning during our electric vehicle session. Use this tool to set up various strategies, modify it, create a credit spread here, and see for yourself, how you want to select, comparing the debit versus credit spreads, and use the P&L simulator and see how they perform, see where you make money, see where you can make the most money based on your outlook on the underlying stock. That's why we built this tool, because it's one thing to learn it, it's a whole nother thing to be able to implement it on your own. So hopefully this gives you a little bit of a glimpse into how you can utilize OptionsPlay to analyze these types of strategies and decide for yourself what strategy is best. So let's talk a little bit about how to construct these strategies. Now, when you're using a debit spread, we usually tell you to use an expiration date that's roughly 60 days from expiration as your starting point. That's where you want to start, 60 days from expiration. And the two legs, what you want to do is you always want to buy the at-the-money call option and sell roughly a 20 delta call or put against it. Now, if you're using the OptionsPlay tool, when you click on the modify button and you use the strikes, as you can see, there are three numbers. You have your strike price, the premium, and you have your delta. So you can use this to help you select your strike prices. The 50 delta is the at the money call or a put. The 20 delta is roughly 1 standard deviation away. And we always pick the 1 standard deviation away so that you are roughly selling something that has only a 20% chance of the stock being above or below those two prices. And we do that on purpose because we're trying to maximize the premium that you collect while minimizing the risk of the stock blowing through those strike prices. So if you use this type of strategy as 50-20 debit spread, the premium that you collect on the short leg will usually offset roughly 20% of the premium of the long leg. So what you're doing is you're actually reducing your risk by about 20% compared to outright buying the call or a put. And that 20% will magnify your returns. So that's generally speaking what we consider the optimal debit spread. And it's important to understand how the relationship between debit versus credit spreads. And I actually have another slide here to talk about that relationship. On the credit spread side, it's a slightly different. Number one, we usually go about only 45 days out because when you're trading a debit spread, you're predominantly long the option. That's the main leg, if you will, is you're long that call or put. And whenever you're long a call or put, you want to reduce time decay. One of the best ways to reduce time decay is go further out in terms of expiration. That's why on the debit spread, we start 60 days out. But on the credit spread, your main option is actually short a call or a put. And when you're short a call or a put, you want to maximize time decay. The best way to do that is selling shorter dated options. So that's why we shift the expiration date between debit versus credit. 60 days for debit, 45 days for credit. Now, on the credit spread, we also sell the at-the-money call or put, so roughly a 50 delta call or put, and we usually buy back about the 25 delta call or put. And the ratio that we're looking for here when we sell a credit spread is that the credit that you receive should roughly be 1/3 of the distance between the two strikes. Now, so when you're looking at a credit spread here, when I talk about the distance, what I'm referring to is the difference between the 54 and the 48. So in this particular case, that's $6 wide. The difference between 48 and 54, I'm selling the 54 put, I'm buying the 48. So the distance between those two legs is $6. What I'm trying to collect is roughly 1/3 of that. In that particular case would be $2. Here, as you can see, I'm collecting $2.65. Anything greater than 1/3 would be better for your credit spread. So whenever you're collecting less than 1/3, that means you're taking on too much risk. You want to collect at least 1/3 of the width here. Here, I'm collecting even more than 1/3 of the width here. So, we always this chart here on the left is just giving you a sense for, depending on how wide the credit spread you're selling, the amount of credit that you're trying to collect off of it. This is just a simple rule of thumb here to give you a sense for whether you're selecting the right credit spreads. And at the end of the day, to really understand the difference between the two, I get a lot of comments from investors. People will tell me, I hate debit spreads because they have such low probability of profits. I think there was a couple of other questions here about probability of profits I will address here during our Q&A session. But, what we want to talk about is the fact that a lot of investors look at this number and they say, oh, a debit spread is such low winners. I don't want that. I want high winners. Let me sell credit spreads. So I unfortunately see too many investors where they only sell credit spreads because they think in their head, oh, that has higher probability. Higher probability is always better, right? If I can win more often, that'll be more profitable. But most investors actually forget that whenever you trade any option strategy, there is a trade-off between probability and risk to reward. And the two counteract each other. Whenever you have high probability, you're always going to have poor risk to reward. On the flip side, if you have low probability, you're always going to have high risk to reward or better risk to reward. So the one is not better than the other. You just have to understand that you are at opposite ends of the spectrum. Now, One is not better than the other. You just have to understand the characteristics of what you're trading. Whenever you trade a debit spread, yes, you are going to win less often. You're going to have more losers when you trade debit spreads. And a lot of investors don't like that. But when you are right, you get rewarded for it. In that Apple example, I'm taking on $500 worth of risk. If the stock makes a big move to the upside, I get rewarded for that. I get paid a substantial amount of return on my trade. When I sell a credit spread, yes, I win more often, but even if the trade makes a big move in the direction that I expect it to, my reward is fairly limited in comparison to the total risk that I'm taking. I'm always taking on more risk than I can potentially make. So that's a trade-off that you're making. And it's important to remember, one is not better than the other. It's just the trade-off that you're making. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you, because this is really at the crux, one of the most important lessons to learn when you're thinking about credit versus debit spreads. I get so many questions from investors saying, which one's better, debit or credit? And the answer is that one is not better than the other. They're so different from each other, and the characteristics are very different. So let's talk a little bit about trade management, right? Once you're in one of these trades, how do you manage them? And this is really where debit spreads, in my opinion, are easier to manage. They're simpler to manage because the rules for managing them are really, really simple. When you buy a debit spread, you pay amount of capital to get into that trade. And all you have to do is monitor how much that debit spread is currently trading for. Just like how if you buy a stock for $10, if the stock goes up to 15, you sell it. If it goes down to 5, you sell it. You have these rules as to when you want to sell it. With the debit spread, it's exactly the same. You want to exit a debit spread upon the trigger of either signal. And there's only 2 possible exit signals on a debit spread. Either stop yourself out when you've lost 50% of the premium that you've paid. So in this particular case, let's say I buy a debit spread and it costs me $3 to get into the trade, or $300 to get into the full contract. Now, if I pay something, if I pay $3 for something and I lose 50% of what I paid, then it's time to cut your losses and get out. So if you pay $3 for something and it's now trading at $1.50, it's time to cut your losses and get out of the strategy. On the flip side, if you buy something for $3 and it starts to go in your favor, meaning it starts to increase in value, you want to start taking profits at about 75 to 100% of the premium that you've paid. So Plug Power, this is the trade that we entered on Monday. This is a debit spread. We are just shy of that 100% goal here on Plug Power in just 4 days of trading. Now, this is it's unusual that you get that type of return in just 4 days, but this is an example of where it's time to start taking profits. Now, for those of you that are a little bit more advanced, you might remember I've recently recorded a video on rolling these types of spreads to turn what is a small winner, a 100% gain, into maybe a 200-300% gain by rolling these types of strategies. So that is another thing that you could do, but that's not what we're talking about today. This is more of an introductory video. For those of you that want access to that rolling video, I'll link to it in the YouTube for the recording. But this is really where you want to start taking profits or consider rolling these particular strategies when you reach about $5.25 to $6, which is 75% to 100% gain on the debit spread. Now, on the credit spread, this is where it's a little bit more complicated. It's not overly complicated, but it is a little bit more complicated, which is the fact that you have 3 signals three things that you have to monitor for potential exits. Whichever one of these 3 triggers first, that is your signal to get out of the trade. So let's say in this particular case, I sell a $5 wide credit spread. So the distance between the 2 strikes was $5, and I collected $2 off of that $5 credit spread. Now, when do I exit the credit spread? There are 3 rules to exiting the credit spreads. I'm actually going to cover number 2 and number 3 first. So when I sell something for $2, remember, a credit spread, I want this to basically go down to 0. So the most I can make on a credit spread is the $2 that I collect. Now, we generally tell you to take profits at 50% of the max gain. So if I sell something for $2 and now I can buy it back for $1, it's time to take your profits and get out of the trade. Keep your profits, go if you can keep 50% of the profits. Now, if the trade goes against you, meaning the spread that you sold now increases in value to 100% of the max gain. So if it goes from $2 to $4, that's when you want to start cutting your losses and getting out of the trade. Now, sometimes you don't get to the take profit or stop loss level, but the strategy that you sold is now at 21 days to expiration. That is also another trigger to get out of this trade. And the reason is because whenever you're selling a credit spread, you don't want to generally hold it in the last 2 to 3 weeks, within that last 2 to 3 weeks, because at that point, the gamma risk starts to outweigh the theta acceleration that you get. Now, I don't quite have enough time to get into the details of all of that. I do have a separate webinar on credit spreads as well. If you want to look at that, I'll link that in the YouTube description. But those are really, the reasons why we don't want to sell credit spreads or hold credit spreads into the last couple of weeks. And it's so important for investors to keep these types of rules handy whenever you're trading these strategies, because I know if you don't have these rules, you're going to be sitting there in front of your screen. When the stock goes in your favor or goes against you, you're going to be sitting there asking yourself, should I get out? Should I stay in? Should I get out? Should I stay in? And you spend a lot of time emotionally figuring out what to do. And it's not a fun process, especially when you're seeing some losses in your portfolio, trying to figure out, should I cut my losses and move on? And that is one of the worst places to be emotionally as a trader. So I always tell investors, have mechanical rules like this, and this way you remove the emotional component. It either triggers the stop loss or it doesn't, and you either just and it's a black and white. There's no gray area. There's no emotional ties to it. It makes your trading easier when you have these mechanical rules. So that's why we have these in place. That's why we stick to them whenever we sell, credit spreads and debit spreads on our daily plays. You see that we follow these rules. This is also to help you get into the habit of trading these strategies and understanding when it's time to take profits and when it's time to cut your losses. So with that covers what I wanted to share with you here today. I already went through some examples before, so I'm not going to go over them right now. So at this point, what I'll do is I'll open this up for Q&A. But before I do, again, just a reminder for those of you that are members, you are already automatically registered for our thematic investment webinar tomorrow morning at 8:30 a.m. on electric vehicles. All of January, we're doing renewable energy. Green energy. So this week we're doing electric vehicles. 2 weeks from today, we're going to be doing renewable energy. So utilities, solar, wind, hydrogen, all of those. We're going to cover that in about 2 weeks. We're really taking on to this 2021 with green energy, giving you a good understanding of the industry, the specific companies within these industries, so that you can better inform your longer term views. A lot of the trades that we talk about here on the Daily Play are shorter term. I know many of you are longer term investors in parts of your portfolio as well. That's why we added these thematic investment webinars to give you more content on that front. So looking forward to seeing our members here tomorrow morning on that. So with that, if you don't have a membership yet and you want to attend tomorrow morning session, you can register right now using the link here on your screen at trade.optionsplay.com/member. Membership is just $75 a month or $500 a year. Or if you've never signed up for an OptionsPlay account either, you have a free 30-day trial. You can register for it at optionsplay.com. It's going to give you access to the trading signals that has the debit and credit spreads that we send out every single day. It includes education like the one you're on today, and as well as access to the OptionsPlay tool, which I just showed you how to analyze debit versus credit spreads with. So that is all accessible either as a member or as a free trial by signing up using that link. So with that, what we're going to do is we're going to open this up for Q&A. I'll try to answer as many questions as I have time for here today. So there are two buttons here at the bottom of your screen. There's a chat window and a Q&A window. Please bring up the Q&A window and I will answer your questions out of the Q&A window. So if you have a question about options, please type them into the Q&A window and I will answer your questions out of there. So, a lot of questions regarding replays. We always send out the replays about 30, 45 minutes after we finish each day. So yes, the recordings are going to be sent out to you. So please type your questions into the Q&A window here. Let's see. Are credit and debit spreads better suited for bull markets versus bear markets? So it really has nothing to do with bull markets or bear markets at all. It really just has to do with your directional view of the market. So, bull markets and bear markets are more, do you want to trade bullish strategies or bearish strategies? You obviously generally heavily trade bullish strategies in a bull market and bearish strategies in a bear market. It has nothing to do with debit versus credit spreads. Blair is saying, Tony, why not buy more time? The money on longer term is not that much greater. So Blair, great question. Blair is asking, why do we buy, let's go back to the Apple example. And Blair, this is actually why I'm doing the session next week on diagonal spreads. Blair is basically saying, if I buy, let's say a March 130, 150 for $6.31, why not buy, let's say a June one for $940? I'm basically buying double the amount of time for only, 50% more premium. The answer, Blair, is because whenever you sell a long dated option, you're not actually benefiting from the time decay, because the long dated options, yes, you get the benefit on the long side, but you're not getting the benefit on the short side. That's why if you want to go longer dated, there's nothing wrong with that, but you still want to sell a short dated option against it. So you might want to sell you might buy the June 130 calls, but you only want to sell the February 150 calls against it. You're actually going to collect more premium by selling shorter dated options more often than you would selling that long dated options going further out. So that's actually what I'm going to be covering next week on the calendar and diagonal spreads. Shall I wait for next market's crash before start placing long-term trades? At the end of the day, I'm not here to tell you how you want to position your long-term trades. And I guess long-term is also very subjective. If you're talking about trying to invest for the next 2 to 3 years, perhaps, but the next market crash could be 2 years from now. And are you willing to give up the gains for the markets over the next 2 to 3 years, waiting for that crash? Maybe that crash doesn't materialize for another 4 or 5 years. It's really hard to see. So that's my take on whether you should wait. As a general rule of thumb, yes, buying long-term plays on a market crash is certainly going to be better. On debit spreads, are we basing stop loss on premium loss and not on specific level of the chart? Yes. So when you're trading a debit spread, your criteria to cut your losses is based on the premium of the debit spread that you pay, not on the chart of the stock itself. Good question. Andrew is asking, what would be the ideal percentage of credit to receive for a calendar vertical spread? Many thanks. So I guess if your question is, if a debit spread, you collect 20% of the long legs premium, the calendar spread, it really depends on how far out that you're buying, or the difference between the expirations. If you're buying a 3-year option and then you're selling a 1-month option against it, you're obviously going to collect a much smaller percentage. So it's hard for me to nail down a specific percentage. But I think one of the things that you can do is look at let's say we're trading a 1-year debit spread. Break down the short leg into 12 pieces and make sure that what you're selling in that 1 month is greater than 1/12 of that 1-year option. You will generally tend to find that you can almost double the premium by selling 1-month options 12 months out, for 12 months, than you could selling 1 12-month option. So, that's a general rule of thumb that you can use, but I couldn't nail down a percentage. Frederick is saying, how do we interpret the options play score? Great question. The options play score is designed, let me just go back to the long call vertical here for 1 second. The options play score is designed to give you a better sense for the risk to reward, the amount of red, how much potential risk do you have weighted by the potential reward. And it also looks at the probabilities. Like I said before, most strategies will look at this. And if you sell a credit spread here, the challenge with credit spreads is that if you sell a credit spread, you have higher probability of profit, but a worse risk to reward. Here you have a really good risk to reward, but really low probability of profit. So how do you tell which one has better risk to reward ratio? That's why we created the options play score, so that you can have this balanced view of risk to reward and probability. So that's what the options play score is designed to do. Again, when should I buy spreads? 60 days. So Richard, you should, if the question is when should you buy spreads, you should buy spreads when you think the stock is going to make a big move. That's when you should buy spreads. If your question is how far out of a spread should you buy, yes, the minimum is roughly 60 days. Anne is saying, I noticed you posted short straddles recently. Please explain the optimal conditions for that strategy. So I am going to do a webinar on January 28th on short straddles and strangles. Specifically, and for those of you that like to trade iron condors and butterflies, iron condors or butterflies are really just an extension of straddles and strangles. And what we have produced is a short at the money straddle and strangle report. So we're going to be launching all of that together. So January 28th is when I'm going to be doing the webinar on that. How does trading volume impact the options price? Jamil, generally speaking, options volume does not impact the options price very much. Now, if there is an unusually high volume, then it could impact the underlying stock price because the market maker needs to effectively hedge using the underlying stock for the trade itself. But that is really more of the institutional volume coming in, a big order coming in, moving the markets. But the trading volume itself has no impact, in my opinion, on the options price. Now, when something trades more often, the spreads are tighter, but that doesn't affect the options price. The fair value of an option is not affected by how much volume is transacted. When I sell a put, if trade goes against me, how can I repair the trade? That's like saying if you buy a stock and the stock goes against you, how can you repair the stock? There's very limited things that you can do to repair a loss. I mean, from my perspective as a strategist working for the past 15 years, I can tell you 90% of the emotional toll that traders take are in trying to figure out how to turn their losses back into gains. Cut that loss, move on to the next trade. You can't win every single trade. You certainly can't repair every single trade, not without taking on more risk. And it never makes sense to take on more risk trying to repair a small loss back into a gain. I can't tell you enough how many account blowups I have seen over the years where someone was down a few $100s, was trying to do something to get them back to break even, took on a little bit more risk, found themselves down maybe $1,000, and then just kept going snowballing from there and turning a few $100 loss into a $5,000, $10,000 loss. So, sometimes that lesson can't be learned by me telling you that. Unfortunately, this is a lesson that many investors have to learn by going through that process. But my best advice to you is if you sell a put and the trade goes against you, that means your analysis on that stock is bullish is wrong, right? You sell a put because you think the stock's going to go higher. But instead, if you're losing money, it means the stock went south. That means your analysis was wrong. There's nothing to be shameful of that. You can't be right all the time. We're always going to get something wrong. And if you can move past that, if you can move past the psychology of just accepting the fact that sometimes you're going to be wrong and you cut that loss, take the $300, $400 loss, move on to the next trade, that's when you're going to become a more disciplined and a more effective trader in the long run, because you're not spending all this time and effort and emotions, trying to figure out how to do this and potentially opening yourself up for much, much bigger loss. So I know that was a long-winded answer, but that was a very, very important question for me to answer for so many of you on this webinar that, are, learning to figure out how to trade, and from my perspective, you can learn everything there is to know about technical analysis and option strategies and gammas and volatility. But if you don't have risk management down, you will struggle as a trader. So hopefully, this inspires you to learn a little bit more about risk management. I have a lot of videos on it, so please take a look at them. I hope that they help you in managing risk. Is the PCCE chart put call ratio helpful? PCCE, let me see. I'm not sure which one PCCE is. I'll try to take a look. That's the equity volume traded on SIBO. So put call ratios are somewhat useful. They are less, I would say they're a little less useful these days than they were before, because things have gotten a lot more stretched than we have ever seen. If you look at the 1-day put call ratio, it's pretty low here at about 55, the 20-week ratio is at 57. 57 is pretty much as low as it's ever been in history. So this is really one of the things where it's used as a contrarian indicator. The question is, are put call ratios useful? Put call ratios historically are contrarian indicators. When you have too much call buying, that's usually a bearish, indicator. When you have too much put buying, that's usually a bullish indicator. So it's useful, but you got to take it with a grain of salt. You can't just use it in itself to time the markets. Mark is asking, on the credit spreads, how would you exercise? Exit the $90 put expiration, the stock fell below 97? So Mark, generally speaking, you don't exercise any of these strategies. If the stock goes below 97, you would simply close out the spread as a whole. You don't want to exercise. It doesn't help you by exercising early. You don't gain anything from that. You actually lose money when you exercise early. There's no economic advantage to ever exercising early. I'll repeat that again. It will never, ever make any economic sense to exercise a call or a put early, because you are effectively giving away free money when you exercise early. The extrinsic value of the option is immediately lost when you exercise a call or put early. So never do that. Always sell the call or put, or buy back the call or put, as opposed to exercising the call or put. Why in the debit spread, Eduardo is asking, is it not so important? It is not so important, the expiration date. I'm not sure what you mean by why the expiration date is not important. I think it is important, that when you're trading a debit spread, that you use an expiration date that's roughly 60 days out. Charles is asking, are the slides available to print? Charles, when we send you the recording on YouTube, you'll see the link in the description to download the slides. Every single video that we put out on YouTube has a link to the slides in the description. Is one strategy better for index versus individual stocks? No, these are two equally identical strategies, whether you're trading single stock or index. The one thing about index is that there's no such thing as early assignment. There's no early exercise because they're European options. So you could say that there's a slight advantage, but again, there's no economic advantage to exercising early. So that's why they don't happen very often. Sergey is asking why your spread sometimes very wide. It is a very risky strategy in my opinion. Sergey, we don't determine the spreads, the market determines the spreads. So if you're trading something that's not very liquid, spreads will be wider, but that's on your choice as to what you trade. And that's part of why we publish a liquidity list every single day. When you log onto OptionsPlay, at the very bottom of your page, there is a link for liquidity. Now, if you want to trade options with very narrow spreads, pick something at the top of the list. Anything that's very liquid here, as you can see right now, there are quite a few, 315 very liquid names. So any of these names in the 315 here, you're generally going to see tighter spreads. And again, the spreads thing, I've discussed this in one of my webinars on entering option orders and talking about, how market makers work and how spreads work. Just because you have wide spreads doesn't mean that you can't trade in between the spreads. I don't necessarily know that you're adding risk by trading something with a wider spread. Since we are in high volatility time, why not construct all strategies to profit from Vega? So here's the thing, right? A lot of investors, and as much as I love Tom Sosnoff, this is the one gripe that I have with him, is that he teaches this style of trading where when volatility is high, you sell, when volatility low, you buy. And those are true statements that it's best to sell when volatility is high, it's best to buy when volatility is low. But what that conveys is that that's the only thing that's important, that Vega is the only thing that's important, changes in implied volatility. But the reality is that huge changes in implied volatility, huge exposures to Vega only affect your options relatively small. But delta, changes in the underlying stock price, has a much, much larger impact on the value of your options. So just a few dollars swing in the stock price can turn your strategy from down a few $100s to up $1,000. But even huge swings in volatility will only affect your option by a few $100s. So why do you want to not optimize just on Vega alone? Because Vega is a relatively small exposure that you have compared to delta. That's why I'm teaching this course. This whole course is based on the fact that, yes, credit spreads are selling in high volatility, debit spreads are buying in low volatility, but despite those two things, despite having a different Vega exposure, the biggest exposure you have with these two strategies is still delta. Always think about your directional view first. Where do you think the stock's going to go? Because if you think the stock's going to make a big move, no matter how high the volatility is, you're better off buying that debit spread. So delta trumps Vega. So yes, Vega is important, but delta always trumps Vega. I hope that clarifies that for you. Carrie, in terms of recommendations, not sure, do you decrease risk by selling below the current market price? I'm not sure what you mean by do you decrease risk by selling below the market price. If the question is, do you reduce risk by selling a credit spread where it's lower? The answer is sort of, not really, because your break-even price. So let's say before, right? Before in the example we were doing, we're selling the 130, 120, right? The break-even price of that is 122.55, 126.55. So as long as Apple stayed above 126.55, I am profitable. But the max risk on this particular strategy is $655. So the question that Gary was asking is, if I move this strike lower, do I take on less risk? The answer is not really, because yes, your break even is lower here. My break even is 122. So as long as Apple stays above 122, I can be profitable, but I've taken on more risk. Before I was trading, I was risking $655. Here now I'm risking $758. So I'm risking $100 more in exchange for roughly $4 of movement in Apple stock. So if Apple moves forward, I have a $4 buffer, a slightly bigger buffer, but if it exceeds that buffer, I'm losing more money. So you're not really reducing risk. Actually, the further you go down, the more risk you're actually taking. So that's why we never sell these really far out of the money credit spreads. You never want to be in the position where for $50 worth of reward, you're taking on $950 worth of risk. That's what we call picking up pennies in front of a freight train. Mitchell is saying, do you ever buy back the short position of the long skyrockets? So Mitchell, generally no. Plug Power is probably an example of this. Where we, now it's up $106. It's above the strike price. We're above the $45 call option here, and Mitchell's question is, do we ever buy back the $45 call? The answer is no. Number one, to buy back the $45 call right now would be extremely expensive. And if, let's say, tomorrow you did that and the stock plummets, you would then lose all of the money on the long leg. So you would effectively have lost more money than the max risk that you would have had if you stayed intact or if you didn't break up the two legs. So for those reasons, I generally will not break that up. Credit spreads, do you close both legs same time? Yes, you close both legs at the same time for both debit and credit spreads. Douglas is saying, hi, Tony, do you ever consider putting on both a credit and debit spread at the same time on the same stock? Douglas, I would say that I don't. That's kind of what they call a double vertical spread, I believe. You can do it. I don't see a strong advantage to doing it, but you can, because you're effectively negating a lot of the benefits of it. I think so. Just to show you here, from my perspective, why I don't think it's worth doing. What you're better off doing, in my opinion. So here's a short put vertical. Let's say I sell the 130, 120 vertical spread, and then I buy, let's say, a 130, 150 call spread, right? That is a, and you can change these strike prices a little bit if you'd like, just so that you're not overlapping strike prices. But as you can see, this strategy, this vertical spread, that's actually what it's called when you sell a put credit spread and buy a call debit spread at the same time. Notice how that is almost identical to this particular trade, the 120, 150. Notice how the two have almost identical trades. almost identical amount of max reward, identical amount of risk. One is 4 legs, one is 2 legs. The 4 legs are going to cost you double in terms of transaction costs. It's going to cost the double number of contracts. You're going to have to pay the spread 4 times. So from my perspective, no advantage of trading 4 legs when you can accomplish the same thing in 2 legs. Richard, should I place a stop loss based on the rules upon entering the position? Absolutely, Richard. I advocate for that. I generally do. If I sell a credit spread for $3, I'll immediately put in my limit order to buy it back for $1.50 and place my limit order to buy it back at $6 or my stop loss to buy it back at $6. I usually place that OCO order immediately after I put on a trade. I run a business beyond trading on my own account, so I am not always in front of my screen. Sometimes I'm on a webinar, sometimes I'm in a meeting. I want to make sure I get out or cut my losses on a trade, so I do have those orders put on. How can I use implied volatility to know whether the debit or credit spread is either cheap or expensive? So if you look at the liquidity profile, we have what's called IV rank. IV rank gives you a sense for whether implied volatility is cheap or expensive. So you can actually sort this. IV rank of very low, like 1 is very, very low. So very low implied volatility. At the other end of the spectrum here, the other end of the spectrum, as you can see, ARKG 69, meaning very high implied volatility. So this is how you can use implied volatility to tell whether a debit or credit spread is cheap or expensive. But the OptionsPlay score is also here for you. The OptionsPlay score tells you whether you're trading something that's cheap or expensive. Wayne, Happy New Year. Thank you, Wayne. If I want to increase my profit potential of the debit spread, is it better to widen the leg I'm selling, or is it better to keep the sell leg closer? So if you want to increase your profit potential, well, there's really 2 ways to increase your profit potential. You can either reduce your risk by trading a narrower debit spread, or you can go further out in time and give yourself more upside. It really depends on how far you think the stock's going to go. So you have a lot of choices, Wayne. It's not like there's only one choice. Both choices can work. It really just depends on whether you think the stock's going to make a big move or a relatively smaller move. Greg is saying, hi, Tony, your OptionsPlay app has an Excel tab for credit spreads, but no equivalent for debit spreads. Am I missing something? You're not missing something, Greg. The reason that we have a credit spread is because of the fact that credit spreads are very forgiving. You don't have to have a strong directional view to sell a credit spread. As long as you have a loose bullish or bearish view and you find that you can find a credit spread with very high credit, that is worth trading. But a debit spread, you need to have a stock that you think is going to make a big move. And that's much harder to find. And that's why we don't have a debit spread spreadsheet, because it's not easy to find a stock that, number 1, you think is going to make a big move, number 2 is relatively cheap, and the debit spread makes sense. So that's why we don't have a debit spread, because there's really no way to algorithmically identify stocks that we think are going to make a big move. Those are all handpicked by us. We do a lot of research, technical, fundamental research to find those types of stocks. And you can't just algorithmically pick stocks that you think are going to make a big move. It just doesn't quite work that way. We really tried. I will tell you, we spent quite a few months trying to build a debit spread spreadsheet like that, but it's impossible to algorithmically pick stocks that we know are going to make a big move. There's too much manual work involved in that process. What does the check mark next to the OptionsPlay score mean? The question is, what does this check mark next to the score mean? It just means out of these 3 strategies, which one has the highest OptionsPlay score. When IV is above 100, is it ideal to buy debit spreads? So first of all, I'm not sure what you mean by when IV is above 100, because IV is a percentage. It could be 200, 300, it could be any number. If we're talking about IV rank, you generally want to buy debit spreads when IV rank is between 1 to 10. Those are the most optimal, or that's when options are cheapest. That's the most optimal time to buy a debit spread. So below 10 on IV rank is optimal for buying a debit spread. In the ideas section on the left, when you click on a ticker, it opens the window. But how do you know which idea is recommended? Some have green check marks, but So Jim, you don't know that until you click on it, because we don't know until the time you click on it, because when you click on it, we're pulling the quotes for 3M and then we're calculating what is the risk reward ratio. We don't know the risk reward ratio ahead of time because we don't know what the the options pricing are going to be. So that's why it's calculated in real time. But if you want to have high scores, sort them by market cap. The large and mega cap names are going to have a higher score than the small and mid cap names, because small and mid cap names are generally going to be much harder to find ones with high scores. Do you recommend presetting, programming, automated exiting trade? Yes, again, I think I answered that question already. As a general rule of thumb, is it beneficial to sell 4 weekly options versus 1 monthly option? Jim, in theory, yes, but in practicality, no, because number one, when you increase your transaction costs 4 times, that's going to offset any gains that you might get in terms of additional premium or additional theta that you're going to increase, that you're going to get. And the second thing is that when you sell 1 week options, you have far more gamma risk, and that gamma risk is actually going to outweigh the acceleration that you get in theta. So for those reasons, we do not believe that it's best to sell 4 weekly options in a row versus 1 monthly option. You're far better selling that 1 monthly option. William, your question about the OptionsPlay score, please send us a question and I'll send you a guide on the OptionsPlay score if you want to give you a sense for, a little bit more in-depth understanding. So Tony, doing longing a bear puts, does longing a bear put spread is a debit spread? So am I selling this and doing the reverse? A bear put spread is a debit spread. So I'm not sure what you mean by if you're doing the reverse. If you could clarify. How does the earnings report fit into the time frame of the option you trade? Not sure that I understand your question. The earnings report just tells you when the stock's going to report earnings. So for example, Delta Airlines reports on the 14th. So you would generally use that as a way to determine, number one, when do you want to enter the trade, usually a few days before earnings, and what expiration date you want to choose off of that earnings announcement. Arnaud, do you use options in your trading or do you use other vehicles, including stocks? So I use a combination of stocks, ETFs, and options in my portfolio. Doesn't call debit spread have a disadvantage of not moving in tandem with strong stock movements unless you are very close to expiration? Yes, but still, for example, you're still leveraging your capital. I'm not sure that that's a disadvantage per se because you're still leveraged. You're just saying that it's not as leveraged as if you outright buy a call option, but I would say that I would rather take on less risk and give up a little bit more of that upside than necessarily take on more risk just to participate in upside if there's an explosive move to the upside, because that explosive move to the upside is fairly rare. And I would much rather give up, have less risk on every single trade and give up some of that explosive upside. And when it rarely happens, it's better off, in my opinion, to take on less risk every single trade than give up a little bit of, and in exchange for that, give up a little bit of explosiveness to the upside. Chuck, if I have a 4-contract debit spread and the call side increases enough to buy out the short side of the spread, does that make sense to do? So Chuck, I've already covered this before. In theory, you can be tactical and do it, but be very careful, because if you buy back that short call and the stock plummets, you will end up taking on more risk than the original max risk of that debit spread. Please explain the technical score on the chart. The technical score is a relative strength indicator. So 3M, as you can see here, barely nudging here, barely moving higher here over the past couple of months, past 3-4 months. That's why it has a technical score of 4, meaning it's underperforming the broader markets. Versus if you look at a stock like Tesla, it will have a stock of a strong, a technical score of 10, meaning it's outperforming the broader markets. So that's how the technical score works. To what extent should volume and open interest be considered in selecting proper strikes? None whatsoever, John. The only thing you should be looking at is liquidity. Liquidity is measured based on bid-ask spread, not based on volume and open interest. The two are correlated, but you should never pick strike prices based on open interest and volume. What someone else trades has nothing to do with what strike prices you should trade. Don't confuse the two. How many days into the trade, if the profit target not reached, should we close the debit spreads? So Sanjay, generally speaking, you'll find yourself hitting one of those profit targets, either the profit target or the stop loss, before expiration. But if you find yourself in the last week and you still haven't hit the target or the stop loss, that's another time to just cut your losses. Or I'm sorry, get out of the trade. John is saying, I have seen call and put trades be down over 80% and then suddenly the last 2 to 3 days jump to profitability. John, you're absolutely right. That can happen. But once a debit spread has lost 50% of its value, the chances of it coming back to break even is less than 15%. So you're much better off saving the other half of the premium, applying it to the next trade where you have a much higher probability of making a profit, rather than holding it and potentially losing the other 50%. Now, you're saying that if it gets to 80%, my point is that you should never let a trade get to 80% loss. You should cut those losses much sooner so that you don't have those big losses. Yes, there's always examples of crazy trades that have been down 99%, with 1 day to go, and all of a sudden gets themselves back to break even, or maybe makes a huge amount of capital. There's always examples of that, but that is an exception and that is not the rule. The numbers are extremely clear on this in terms of you're better off cutting your losses rather than holding and hoping that you make your money back. Michelle is saying, you were talking about the plug play. How do you manage the fact that the stock has exceeded the price of the upper leg? So that's exactly, I think this is a great learning moment. We're going to teach you exactly how to do it with the plug power. So stay with us over the next couple of days. I'm trying to decide today whether we take profits on this or roll this, or if we hold it for a couple of more days and extract some of the premium on the short leg here. So I'm going to be doing a little research this tonight to decide which one's most optimal. I'm the holder of a put option of a stock that is going to be delisted tomorrow. Does the same suggestion to not exercise apply? I don't know what you would get if you were to exercise your put. But so yes, my comment on your put option is exactly the same. You're better off selling the put option than exercising your put. You're going to make more money from selling your put option than you would from exercising early. Tom, I am presenting at Well 365. Is it okay to exit each leg of the spread separately? You can, but I do not recommend it. As a general rule of thumb, is it beneficial? I think I've answered that question. What I meant is that in the debit spread, we do not have a trigger time to close the trade. That's correct, but that's because debit spreads are not. So the reason that you have a time trigger to sell a credit spread is because gamma risk starts to become a problem. Gamma risk actually works in your favor when you're long the debit spread. That's why we don't have the time component of the debit spread. Why not use out of the money probability percentage in selecting an option? It is one of the criteria I found very helpful in strike selection. So John, the inverse of the delta is the out of the money probability percentage. So that is what we're doing. We're using delta, which is the in the money probability percentage, but if you use the inverse of that, it is the same metric. One of my favorite trades has been a call debit spread that is financed by selling an out of the money put, which is also known as a call spread risk reversal. These are sometimes mentioned as a debit spread with risk reversal. Any comments, Greg? So yeah, it's called what we call call spread risk reversal is what it's called on options action. It is a very interesting trade. It is one way to offset the cost of the trade. So what we're doing is we're saying we're still buying the call spread here, but what we're doing is we're going to sell a lower strike put against it. So maybe you sell a 770 put. Whoops, sell, not buy. And that's what the trade looks like. As you can see, the profile of that looks very similar to selling a put option. So from my perspective, it gives you very similar risk profiles as selling an in the money put option. And that's the only comment that I have. It's not good, bad. It's a different strategy. Okay, I really want to get to more questions, but I really don't have more time. I've already spent 40 minutes on answering questions, but I really appreciate everyone taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of debit versus credit spreads. I answered a lot of other questions regarding options, so I hope that I was able to get to some of your questions. So with that, I want to thank everyone for taking the time out here this afternoon. I love to see some of you that are members tomorrow morning on that electric vehicle session. I know many of you are looking forward to that, so I'm looking forward to presenting that to you guys. So have a great night. We'll send you the recording as soon as we finish, and I'll see you bright and early in the morning. Have a good night.